In this lecture, we're going to focus on the final audit procedures. Where we are in the audit process is that our test of controls and our substantive testing has been completed. So we are completing the audit and going through some very specific steps that are generally considered outside the scope of the transaction and account balance testing that we do in the substantive phases of the audit. The first thing that we want to do as far as the final audit procedures is review for contingencies. If you remember from your accounting class, a contingency is something that it's probable that we're going to have to pay, and we are reasonably able to estimate the amount. An example of a contingent liability would be litigation. Litigation is an item that organizations get sued all the time. But to the extent where it's probable that we're going to have to pay and we are reasonably able to estimate the amount, is we have a requirement based upon GAAP to report a liability and to report a corresponding expense. Now, management has responsibility for designing policies and procedures to identify these types of contingencies, and the auditor has a responsibility to identify and account for these contingencies and to make sure that the disclosures are appropriate. The key element related to contingencies is what we call a legal letter. This legal letter is sent to the attorney of the organization, and this letter is a request from us through the organization to identify any contingencies and the possible impact it has on the financial statement. We're also going to be looking at estimates. Now, as you look through this list here, what you notice is that we're not talking about specific transactions, but we're talking about management decisions, such as the fair value of many of the assets, the net realizable value of inventory and receivables, any loss contingencies, revenue contracts for percentage of completion. Many of these things, or actually all of these things, represent transactions that are initiated based upon a management decision. So part of our audit is that we are reviewing the financial statement presentation and estimates made by management. So what we want to do is we want to consider these from a reasonableness perspective and make sure that management has documented these estimates in such a way that they have been put together from an objective perspective. If you notice, as you're considering this list, is these have a significant impact on the final output of the financial statements. So it's absolutely critical that we, as an auditor, understand where these estimates are coming from and make sure that management has the documentation to support the fact that these estimates were done in an objective manner. The auditor should focus on the assumptions that management use based upon the significance of the estimate, sensitivity to variations, any derivations from historic patterns, any subjectivity and susceptibility to misstatement and bias, and inconsistency with any current economic trends. We're essentially making sure that management is not using these estimates to what we call manage the earnings. These are critical elements within what we're doing within the audit, and in fact is probably one of the most significant things that we can do in terms of making sure that the financial statements are presented fairly. Part of our audit is going to be considering the disclosures. We're looking at the disclosures from an adequacy perspective. We want to read the disclosures, understand where this information is coming from, understand the notes, make sure that the information is accurate and complete. We need to have reasonable assurance that the disclosures are adequate. Disclosures represent events and transactions that have occurred. All disclosures that should have been included should be there, have been included in the financial statements, that they're understandable, and that the information and amounts are accurate. We're also considering issues related to compliance with laws and regulations. Any acts of omission related to laws and regulations may in fact relate to some of the contingent liabilities that we're talking about. And what we're interested in is how these omissions and non-compliance with laws and regulations actually represent a risk as well as a financial statement error within the financial statements. Part of the ending process relates to what we call an evaluation of the going concern assumption. Now keep in mind that the goal of the audit is to provide an opinion of the fair presentation of the financial statements. Well, the issue is that we as auditors actually have a tremendous insight in terms of the organization. So besides just reporting the fact that the statements present fairly, what we're interested in doing is making sure that the organization is in fact a going concern. A going concern is an organization that is going to continue in business for at least beyond the next year. So what we're looking for is we're looking for the company's going concern status for a reasonable period of time. Again, the reasonable period of time is a period not to exceed 1 year beyond the date of the financial statements being audited. The responsibility of the auditor is to evaluate the appropriateness of the evidence. We're going to use certain ratios as predictors of bankruptcy, and our responsibility as an auditor. Just kind of think about this from the perspective of the user of the financial statement. They are expecting us to provide insight in terms of the going concern of the organization. That's an assumption of the organization that we have as we're continuing the audit. And in fact, if the organization is not able to continue as a going concern, financial statements may be presented fairly, but we certainly need to notify the users of the financial statement. And we will do this in the audit opinion letter. We'll be talking about that in the next chapter. Some of the things that we are going to consider as we're looking at potential going concern issues are any negative trends related to cash, sales, net income, internal and external factors. Maybe we're considering external factors from competition, internal factors in the internal turmoil within the organization. We're considering the competitiveness of the market. And then we have this thing that we call the Altman Z-score. Beyond the scope of this course to talk about the Altman Z-score from the perspective of a going concern, but it's an interesting ratio, and it basically has a predictive power related to the likelihood of bankruptcy. As we are assessing the risk of a going concern problem, we need to consider any mitigating factors. We need to consider and assess management's plan to overcome these problems, identify factors most likely to resolve the problem, consider and independently test the adequacy and support for major assumptions, and evaluate the reasonableness of other assumptions made by management. We need to evaluate these assumptions, such as increasing price of the market share in relationship to other developments. Cost savings related to a reduction in force may be evaluated, recomputed, and identifying how this is going to impact the organization. Perhaps the organization is in the process of selling off assets. All of these things need to be taken into consideration, because ultimately, if we believe that the organization is not going to be around for the next period, then we're going to report this as part of our opinion letter. But before we do, if we identify a problem, we want to consider management's response to this problem before we actually issue the letter. Let's talk a little bit about analytical procedures. Analytical procedures are these ratios that we use, and if you remember, the auditor is required to use these analytical procedures at the beginning of the audit and at the end of the audit. We also have identified analytical procedures as appropriate substantive testing. But essentially, the analytical procedures that we're using at the beginning of the audit are used to assist the auditor in forming an overall conclusion about the financial statements. Essentially, at the beginning of the audit, we are looking at these analytical procedures to identify areas of risk. And at the end of the audit, we're looking at these ratios to determine if our conclusions are correct. Keep in mind that during the course of the audit, we have made recommendations, we may have made recommendations to management in terms of changing specific amounts within the balance sheet and the income statement. This will impact the ratios. So the ending review ratios that we're doing at the conclusion of the audit essentially gives the auditor an opportunity to step back from the audit, reassess what these ratios mean, and provide a better understanding of the client and the overall conclusions related to the audit, and make sure that there's nothing that possibly was missed in these beginning analytical procedures. If this is an audit that is also required to complete the Sarbanes-Oxley 404 audit related to internal controls, is we need to make sure that management's representation letter is there. Keep in mind that management needs to represent the fact that they are responsible for these internal controls. They also need to represent that the internal controls are functioning appropriately. So the specific responsibilities to management specifically relate to the internal controls related to financial reporting. Prior to the audit being issued, the auditor absolutely needs what we call a management representation letter. The management representation letter is signed by the CEO and the CFO of the organization. It reminds management of their responsibility to the financial statement. It confirms any oral responses obtained by the auditor and reduces the possibility of misunderstanding, and absolutely reduces the risk to the auditor in terms of being sued. Because essentially what this management representation does is it represents that management has provided all information to the auditor. If management refuses to sign the letter, this basically implies that there are untruths, or there's untruthfulness in verbal representations that the management has given. We would absolutely consider a scope limitation to this, and we'll talk about this when we start talking about the audit reports. And by the way, the auditor that was conducting an audit of one of the organizations that I was with basically said, we're not issuing the audit report until we get the letter. And there was no conflict, it just was a timing issue. I was asking for the audit opinion letter so I could include it in a package for the audit committee. Auditor said, we'll give it to you as soon as we get the letter. It's very, very important, absolutely critical to the auditor that they get that representation letter before they're issuing the opinion. We need to review subsequent events and subsequently discovered facts. Now, make sure that we understand what these are. In the next slide, we will discuss these. But what we're talking about are events that occur after the balance sheet date. And there's some very specific procedures in terms of subsequent event, or very specific time frames related to subsequent events and subsequently discovered facts. Those are two separate terms, and we'll talk about these in a minute. And what we are considering are events that occurred at the end of the financial statement date, but have been clarified, or events that arose after the date of the financial statement. So here's what we have. So you notice that the balance sheet date, let's say it's December 31st, this period between the balance sheet date and the audit report date is when the auditor is on site conducting audit procedures. Once the auditor is completed with the audit, this is when we date the audit report as of, let's say it's March 1st. Now, there is a time period, which is B, that's after the auditor has left and the date of the audit report and the date that the financial statements are issued with the audit report. So that's B. So B is the subsequent period. Now, once the audit report and the financial statements are issued, we have no more responsibility unless, as you see in C, C is the period of the subsequent discovery of facts. So let's talk about the subsequent period B first, before we talk about a separate issue, which is the subsequent discovery of facts. So the subsequent events, dates, is the time period from the balance sheet date to the issuing of the report to the client, which is at the end of B. This is all the subsequent period. So let's consider this. So subsequent events, again, these are items, and we divide these in two separate categories, category or type 1 and type 2. These are things that occurred in the subsequent period, again, this period between the balance sheet date and the issuing of the financial statements that have an impact on the audit. A type 1 event is a subsequent event that existed at the balance sheet date, and we have clarification of this. So as an example, a type 1 event is where there is a contingent liability that we reported on the balance sheet date. Let's say it's a litigation, we have a contingent liability of $100,000 and expense of $100,000. During this subsequent period, we actually settled the case. So we settled the case not at $100,000, but at, let's say, $500,000. If that difference is material, then what we would do is we would change or adjust the financial statements. A type 2 event is something that did not exist at the balance sheet date, but occurred during the subsequent period and doesn't have an impact on the numbers, but actually would have an impact on someone that actually is reviewing the information. So let's say that during the subsequent period that the organization issued 10 million shares of stock. It has nothing to do with the December 31st balance sheet date, but having this many shares in existence during the subsequent period would cause a reviewer, external party reviewing the financial statements, maybe to consider this investment differently. It's going to impact earnings per share, might impact a number of other ratios. So what we might do here, we certainly aren't going to change any of the balance sheet information, but we would disclose the fact that this occurred and disclose what the impact is on it, maybe on earnings per share, cash, and other types of events. So that is a type 2 event, subsequent event that did not exist at the balance sheet date. Audit procedures concerning subsequent event, we want to consider cutoff tests. We want to review subsequent collection of receivables, search for unrecorded liabilities, read minutes of the board meetings, compare and read the interim financial statements during the subsequent period, inquiries to management related to this. All of these things are going to help us understand what has actually taken place related to this. We want to consider the significance of contingent liabilities. Again, understand how this has any resolution of contingent liabilities during this subsequent period if the balance sheet, the information needs to change, any significant changes in working capital. So if we look at some of the interim statements, we see a significant increase or decrease in cash, we're going to start asking some questions in terms of what's taken place. We want to determine the status of any items that were tentatively concluded but not fully concluded, and any unusual adjustments in the financial statement. Now, when we're talking about this period, and this period is between the audit report date, when we have completed the audit, and the actual issuing of the financial statements. This is a period of time where we would consider a dual dating. So basically, we're out of the facility, we're done with the audit, but something took place. We concluded a contingent liability, we issued stock, we did something. We would consider what we're calling a dual date. So the dual date would say audit report date March 1st, except for note 23, which is dated March 6th. And the reason that we want to do this is we want to restrict our liability to that audit report date. But the other valuable piece of information related to the dual dating is if you read the financial statement, and everyone should be reading the audit report before they look at the financial statement, and they see the dual dating, they'll say except for note 23, which is dated March 6th. First thing that we're going to do is to go look at note 23 and see what has actually taken place. So again, restricts the liability, less responsibility for the auditor, because we're just saying the audit is done on March 1st. Financial statements are issued later, but the audit report is done then. So we're not extending our liability or responsibility beyond that, but we are focusing our attention on this specific event. The last piece that we want to talk about are subsequently discovered facts that become known to the auditor after the release of the audit report. This is period C. This is not a subsequent event. This is a subsequently discovered fact. So you need to understand that there is a distinction. Our responsibility after the financial statements are released is actually very limited, except when there are subsequent discovery of facts. Now, usually when this happens, this is because it was discovered after the financial statements were issued that management was committing this fraud. It was then exposed, and we have all kinds of issues. If the issues, and the issue is, if the facts had been known at the report date, the auditor should determine the reliability of the new information, whether developments or events had occurred by the report date, whether users are likely to still be relying on the financial statements, and whether the audit report should have been affected by these facts known at the report date. So the clear indication is here, if there was fraud that was discovered after the report date that is going to impact the audit report that we issued, then essentially we have to retract this audit report. The standards require that we notify those that are known to be relying on this information, and from an audit perspective, this is not a good thing. So we need to understand that while our responsibility after the audit report is limited, if it's discovered that there was something significant that occurred, and again, we're generally talking about some sort of fraud, then we have a significant responsibility to make sure that our audit report is no longer associated with those financial statements. Okay, so I hope this clarifies a couple of issues in terms of concluding the audit. So I thank you very much for your time and attention. Thank you.